as we've heard from a lot of investors during the panel, during all of the panels, right? From international investors and from local investors, that I think one of the major restrictions for them to invest in infrastructure projects, either greenfield or brownfield, is that none of them in the capital markets, have the appetite to run the initial risk of the project. So they need the project to be in place and operating, because they don't like to run the completion risk, the so-called completion risk of the project, right? So there must be some part of the market that takes that risk before and then offer it to the market later. And there's a consensus that the players that need to have the ability to run that risk, to understand that risk better, is the bank market. But as of now, the bank market does not have enough stimulus to run that kind of risk. So this is something. This is an equation that needs to be, somewhat resolved, right? Both from the market, from the government, and also from the investors. We need that kind of input from the investors so that the government sees the need to somewhat make a stimulus for the bank markets to cover that kind of risk. They're changing their investments dramatically, I would say, because in the past we used to see, I'll talk about the local investors, right, which I'm more familiar with, right? In the past we used to see a lot of appetite for very long tenor securities, like 10 to 15 years, right? And when the market goes sour, the first thing that hits the investors is their appetite for tenor. So it used to be an appetite for 10 to 15 years, turned into an appetite to, at the most, 5 years, and the sweet spot being 3 years. So that creates a lot of difficulties for the companies to make the decision to tap the market, because they're always looking to the capital markets as a source of long-term funding. Whereas currently, in this environment, everyone is, there's a risk-off sentiment, right? And everyone kind of, reduces the duration. So that has reduced tremendously the number of issues that came to the market this year. I think we're starting to see some, a little bit of improvement, but I still think that this year is going to be a difficult year, but I'm very positive that 2016 will be a much better year for the capital markets. Some of the discussions that we heard during the panels, they're very familiar to just one part of the market, to the underwriters and to the professional investors, and perhaps to some of the companies. But there are a lot of discussions that we heard here today, a lot of views, both from the investors and from the government, that it's not very clear to the other participants of the market. So an event like this makes it possible for everyone to have access to the kind of information that only those that deal with it on a daily basis, like ourselves as an underwriter, do. So this is, I think this is why this is so important. Well, I think we try to, right, leave a message of, positiveness. Is this correct? For the future. We know that currently the market, it's kind of, a little bit closed. That only, high-grade companies with very high ratings can access the market. But I think that, the discussions that we had, especially in the panel that I participated, was, to show that there is some hope, for not so the companies that are not very well rated, or projects that are not very rated, to come to the market in the future.